Hey everyone, welcome back to Taiga's financial journey. Today, we're diving into a popular investing strategy that can take the fear out of market volatility, dollar cost averaging, or DCA for short. If you're new to investing or looking for a disciplined approach to build wealth over time, stick around because this video is for you. Let's start with the basics. Dollar cost averaging is a strategy where you invest a fixed dollar amount on a regular schedule, say monthly, quarterly, no matter what the market is doing. The key idea is simple. When prices are low, your money buys more shares. When prices are high, you buy fewer. Over time, this can lower your average cost per share. Now, you might be wondering, where does this idea come from? The concept was popularized by the legendary investor Benjamin Graham in his 1949 book, The Intelligent Investor. Today, many retirement plans like 401ks and KiwiSavers use DCA without realizing. Here's a simple example. Imagine investing $1,000 monthly into an S&P 500 ETF. The share price might be $100 in 1 month, so you buy 10 shares. If the price drops to $90 the following month, you get about 11.11 shares. Continue like this and your average cost per share can fall below the market's current price over time. So why does this actually matter? And there are several key benefits of DCA. Reducing timing risk, lower average purchase price, encourages disciplined, consistent investing, and provides psychological comfort during market swings. Firstly, DCA helps you reduce timing risk. No one can predict precisely when the market will hit its lowest point. Investing regularly removes the stress of trying to time your entry perfectly. Second, you get more shares when prices are low, potentially lowering your average cost per share. Third, it's all about consistency. Setting up an automatic investment plan makes you less likely to let emotions dictate your decisions. And lastly, it gives you peace of mind, especially if you're a nervous investor. Of course, no strategy is perfect. Critics of DCA point out that in a steadily rising market, lump sum investing might yield higher returns because more of your money is working for you sooner. There can also be extra transaction costs if you're not using a commission-free platform. And remember, DCA won't save you if the market keeps declining. It's important to understand these trade-offs. Studies have shown that if you have a large sum available, investing it all at once can outperform DCA in about 70% of rising markets. But here's the catch. Most investors are too nervous to invest a large sum at once. For many, the alternative is not investing, making DCA an innovative, accessible option. But let's talk about real life. Consider what happened during the 2008 financial crisis. Many investors holding cash eventually used DCA to re-enter the market during recovery. By investing gradually as prices dropped, they could buy shares at a lower average cost, and when the market rebounded, these lower costs led to significant gains. Here's another scenario. Imagine you receive a $20,000 inheritance. Instead of investing it all at once, you invest $2,000 monthly for 10 months into a diversified ETF. Even if share prices fluctuate between 90 and 110 during that period, you end up with more shares at a lower average cost than if you had invested the entire sum at one point. Now let's address an important psychological factor. Many of us are prone to emotional decision making. The idea of investing a large sum can trigger anxiety. What if the market drops right after you invest? DCA helps elevate that fear. It forces you to stick to a plan, reducing the risk of panic selling and allowing you to benefit from the market's eventual recovery. Modern brokerage platforms have made DCA even more attractive by eliminating transaction fees. That means you can invest smaller amounts regularly without worrying about extra costs eating into your returns. While DCA may not always capture the maximum possible return in every situation, it's all about managing risk and building good investment habits. If you're just starting out or someone who delays investing due to fear, DCA is a great way to get your money in the market and benefit from the power of compounding. Some investors take DCA a step further by using a value averaging strategy. Instead of investing the same fixed amount every time, you adjust your contributions based on market performance. Essentially, you invest more when prices drop and less when prices rise. While this method is more complex, it can yield to higher even returns. But if you prefer simplicity, sticking with traditional DCA is perfectly fine. To sum up, dollar cost averaging is a fantastic strategy for those looking to invest regularly without trying to predict market highs and lows. It reduces risks, lowers your average cost per share over time, and helps you build a wealth steadily. one consistent investment at a time. If you found this video helpful, hit the like button, subscribe to our channel and ring that bell so you never miss an update on innovative investing strategies. In the comments below, comment, have you tried dollar cost averaging and what's worked for you? And thank you for watching Taiga's financial journey. Remember, investing is a marathon, not a sprint. Whether you're a beginner or a seasoned investor, the key is to stay disciplined and keep your eyes on the long-term goals. See you in the next video. Bye bye.